Hi. Sometime back I saw this newspaper headline giving data on inflows into funds in January, and one figure leapt out, which was that the inflows into the gold ETFs and fund exceeded the inflows into equity mutual funds in January 2026. If you go back a few months, around March, April last year, there were hardly any inflows into gold funds, whereas equity inflows were still of the same order, around 24,000 crores a month, and now gold inflows are more than that. And I have made earlier a video specifically on gold and how volatile its history has been. I'll give a link to that. But more than, this is not about gold. This is about a basic mistake in the investing framework. I mean, imagine driving a car facing backwards, that you're looking at the road that has gone by rather than looking at the road ahead. The road ahead might have opportunities, it might have danger signs, but you're ignoring all of that. You are looking back at the landscape and the road that is already behind you. So that is the way, unfortunately, a lot of time we do investing. We look backwards, which is part of it is recency bias, that we think anything that has happened off late, that is the way the world is going to be. Gold has done one off late, or whatever. It might be a theme, it might be defense stocks, it might be small caps, it might be a particular country, and we say that, okay, let me pile in now. And that is almost always the worst time to pile in. I mean, we have done this exercise that if you systematically, let us say, invest in whatever has done the best in the last period, you will systematically underperform. And this is true of investment strategies also. If you look at some of the newspapers have brought it up at various times, that if you look at the very best performing schemes, whether it is mutual funds or PMS in a particular period, let's say a year, next year you will often find those same schemes are way down the list. So that is the chasing performance, whether it is asset class, whether it's country, whether it's sector, or even investment strategy, is the worst way to invest. And the flip side often to that is that if it is a well thought out strategy and there has been a period of underperformance and then you quit, you are probably quitting at the worst time. So it works both ways. So don't chase performance of something that has done well of late. वो train छूट चुकी है, the train has already left the station. Don't try to clamber onto that train. There will be other opportunities, other places to make money. Already, as I am making this video, the price of gold is down from where it was in end of January. So already people who have invested at that time are sitting on some reds in their portfolio. So, but as I said, it's not about gold, it's not about making a prediction about gold, it is about this whole strategy of chasing what has done well of late. So always have that image in your mind that what you're doing is driving a car facing backwards, whereas you should be looking forward at where are the opportunities, where are the dangers, where should I be invested today. So I hope that helped, and if you have comments and questions, do let us know.